Hello everyone, welcome to the HODLcast. We are on the brink of a major black swan event in the banking sector. Nearly $90 billion of the market cap has been swept away in the past 48 hours of trading. Silvergate Bank failed on Thursday, and then on Friday, Silicon Valley Bank went under. Its stock went down to $36 a share. Given, JP Morgan had a price target of $375 for this stock, it was a completely unexpected, unanticipated failure. A bank run ensued, and the FDIC stepped in and put Silicon Valley Bank into a receivership on Friday, midday. Ironically, the past several months, all the regulators seem to have been focused on the crypto sector, the risks that poses to the banking industry, putting that Operation Choke Point 2.0, and it has really turned against them because now, we have a major non-crypto related bank failing and a possibility that on Monday it's going to be blood on the streets, contagion with a lot of small banks that are in a similar situation as Silicon Valley Bank. So what happened? This is actually the second largest bank failure since 2008 when Washington Mutual went down. Silicon Valley Bank had $211 billion of assets deposited with them, and they invested $80 billion of that into long-term treasuries or mortgage-backed securities. You may remember MSBs or mortgage-backed securities from the 2008 financial crisis. They're, the main thing that everyone was trading, thinking they had these high-rated securities inside of it, and it turned out it was subprime assets. Right now, it's a little bit different. The problem with these investments is that they do well in a low interest rate environment, but over the last 18 months, the Fed has increased the interest rate by 4%. So all of these investments that were made a few years ago that made sense, now they've completely plummeted in the rising interest rate environment. Once rumors started spreading, everyone began taking their money out of Silicon Valley Bank, causing a major bank run, and they couldn't cover deposits, so the FDIC had to step in. Silicon Valley Bank published that they took a $1.8 billion loss on their available for sale securities. So for comparison, this company made $1.5 billion last year and $1.77 billion the year before. So effectively, this available for sale securities sale eroded a whole year worth of earnings for them. There are unrealized losses on some of these long-term treasuries, so it shows $91 billion as their value. But remember, anything that's listed as an asset is usually borrowed on a bank's balance sheet. Their assets are money that they have lent out to other people. And here they have, so it's worth $91 billion if held to maturity, but if they had to sell these assets now, their fair market value is $76 billion. So there's a $15 billion unrealized loss right there. And as the bank run happens, they have to sell these assets so that they can cover the deposits being called out of the system. So who's impacted by this? Well, approximately 44% of Silicon Valley companies banked with Silicon Valley Bank. The bank was offering very easy loan terms, so anyone almost could walk in with their startup, pre-revenue, pre-financial statements, get a loan, but the caveat for that loan was that you had to do all your banking with Silicon Valley Bank. You had to hold all your deposits there, pay all your bills through there, do your payroll through there. So these companies, $250,000 is how much the FDIC insures in any deposit account. Some of these companies had tens of millions of dollars in there. We know JP Morgan gave them a price target of $375 per share just last November. So right around the time of the FTX collapse, the JP Morgan said, Silicon Valley Bank, they look good. They don't have, JP Morgan acknowledged this $15 billion of unrealized losses, but said it won't matter because they should have a lot of capital coming into the system in the coming months. Turned out money for startups just kind of dried up. There wasn't a lot of venture capital activity in the last few months. It's been, on the peak of recession. So the bank did not get a lot of deposits like JP Morgan predicted. In fact, it got so little that it started having to sell these assets that should have been weighted for the long term, but they had to sell them shortly for a loss. JP Morgan itself has some major unrealized losses on its books as well. On their December financial statements, as reported in their annual report, it shows that JP Morgan has $185 billion lent to various institutions. So we don't know who those institutions are, but if the banks start crumbling and it turns out JP Morgan doesn't get some of that money back, they could be in trouble too if they got a bank run. There was some major insider trading that happened at Silicon Valley Bank, which is, kind of shocking and disappointing. We saw the same thing with the Celsius bankruptcy, Alex Mashinsky paying himself handsomely in the look-back period or the period right before the bankruptcy, and we saw that here with the CEO just 12 days ago. He sold 11% of his stock, which resulted in a $3.57 million sale. And he had not sold any stock in several years prior to this. This same CEO was also a director on the San Francisco Federal Reserve, and he was actually fired yesterday because of the bank's implosion. The company's CFO also sold shares 12 days ago to the tune of $375,000 worth, and this chief marketing officer sold shares in early February. We don't know how much. So Circle was holding $3.3 billion of cash at Silicon Valley Bank. So the USDC stablecoin has depegged. At the time of this recording, it's gone down to 91 cents per share. A lot of people are taking this as an arbitrage opportunity between Circle and Tether. On some DeFi sites, Tether went up to $1.07. So there's a 20-cent spread there. Usually arbitrage brings the true price closer, but here where there's a 10% loss of the funds backing USDC, it's interesting to see what's happening. Stablecoins have lost a lot of trust in the last 24 hours. Only 3 of them have kept their peg. Most have gone depegged. But I think the USDC stablecoin will be fine in the end. You've got to remember, stablecoins are kind of sticky assets. For the USDC, there's 8.1 million that are locked in blacklisted wallets, so those aren't going to move. There's thought to be tens of millions worth of stablecoins that are in wallets that the owner has lost access to, so those won't move. There's over 300 million USDC locked up in various bankruptcies of crypto firms. FTX, Voyager, Celsius, and BlockFi all have this USDC on their books, so that's not likely to be moving or won't be recalled anytime soon. And there's lots locked up in various funds or DeFi funds. For example, there's a company called the Indian COVID Relief Project, and they have 242 million worth of USDC, and they haven't moved anything for over a year. So it's not like everyone on Monday is going to be redeeming USDC. But there were a lot of people trying to redeem over the weekend. Coinbase has frozen redemptions on it, and we'll see what happens on Monday. It's pretty funny that, everyone's been casting so much shade on Tether over, the last number of years, but here it is. Tether's the safer one than USDC, and everyone's right now selling USDC in favor of Tether. So there's some major contagion risks. The CEO of Y Combinator went on the news on Friday night and scared the crap out of everyone. He said he thought it's going to be around a 10-year setback for Silicon Valley companies, that a lot of them are just going to be out of business as a result of this. They're going to have to lay off all their staff. They're going to have to abandon their projects. Then the VCs are going to be out a lot of money, and it just, he painted a really dark picture. Even if through the FDIC receivership, companies do get access to their money back, which is not at all guaranteed. They're only guaranteed the first $250,000 they had in the account. But even if they got their money back, these companies still rely on lines of credit for their day-to-day expenses, especially in this recessionary environment. And those lines of credit certainly will not be reopened on Monday for businesses to use. The companies we know so far that have money sitting on Silicon Valley Bank include Circle with $3.3 billion, Roku $487 million, BlockFi $227 million, Roblox $150 million, Ginkgo Bio $74 million, iRhythm $55 million, Rocket Lab $38 million, Sangamo Therapeutics $34 million, Lending Club 21 million, and Payoneer 20 million. So, sure they can get 250,000 back, but we're talking a lot more money than that. One estimate is that 97% of the assets are uninsured. So let's talk a little bit about BlockFi. My goodness, this company, first they go and sell everyone's Bitcoin for $16,000 based on the lowest price of this bear market that was established on November 10th. They sell everyone's Bitcoin for $16,000 a coin and then deposit it in Silicon Valley Bank, $227 million. That money's lost. So it's like a double bankruptcy for these people, and they were supposed to have it insured. One of the bankruptcy rules is that you can't have cash just sitting there vulnerable in bank accounts, and the trustee for BlockFi actually pointed this out to them on Monday. They did not make any action or change the account structure, and here we are. That money is just lost right now. Bill Ackman is making some major accusations or call outs on Twitter asking that or demanding that this bank should be bailed out. He's saying that he's heard that they're going to be offered, the companies with money on it are going to be offered around 50% of their deposits back on Monday, and he thinks that's not good enough. The government needs to guarantee all of this money back to depositors, and if they don't, we're going to see a huge run on all the other banks because no one's going to feel comfortable with their money anywhere. So the FDIC is going to be tasked with selling 80 billion worth of mortgage-backed securities that were on the books at Silicon Valley Bank. So it'll be interesting to see, who comes in, who's willing to buy this distressed assets. And, it needs to be someone with a lot of liquidity that can hold on to them for the long term because they are dropping every time the rates go up. It was offered to JP Morgan and they declined. Elon Musk talked about having Twitter buy this, bankrupt bank. I think that would be amazing. I would love to see that. And a lot of people were joking on Twitter as well that CZ might step in with a bid since, he has been instrumental in some of the crypto-related bankruptcies, buying up the Voyager assets and making an offer on the Celsius one. So maybe he'll come in and make some offers on these banks. As a closing thought, putting your money into Bitcoin and self-custody is probably the safest spot right now since we don't know what's going on with these banks. Thanks for watching, and if you like this video, make sure to hit like, subscribe, and leave a comment. Thank you, and have a great day.